I'm a long-term owner of Apple. The key metrics to me that would make me continue to own it is a high free cash flow yield of 7%. They're growing their dividend at 14%. The price to earnings ratio is a more compelling 14 times earnings. So from a dividend growth, free cash flow yield and free cash flow growth, you're going to get this with Apple. I saw it in 2012 and 13 when it fell, and yet the market continued to go higher, and Apple got right back on the bicycle and proved that it's a great shareholder wealth creator.
You can have all of those nice numbers, obviously, David, but the stock market may not agree, or they may look past those numbers, and the sentiment can hold an otherwise good stock by the measurements down.
Absolutely. Whether it was mid-2012 to mid-2013, episodes in 2015, Apple will lag. But nevertheless, if you look at it over the long term as a good allocator of capital in the best interest of shareholders, Apple is a name that you can own. And down 20%, I don't like it, but it's still holding up better than so many pockets of tech that are down much more.
And for a long time, Apple was looked at as one of the defensive stocks in the markets. And so, Eric, for all the reasons that David had mentioned, investors sort of thought that this stock would be more immune from sort of the downturns. And it's not a Netflix, it's not an Amazon. I mean, when you're having a conversation about whether valuations support fundamentals, it's sort of the FANG stocks, the true FANG stocks, F-A-N-G, that seem to be the poster children of that. Apple, not so much, because the amount of cash on the balance sheet and the fact that they're going to be buyers of their own stock in spades. So what does this exemplify? Is this emblematic of a broader problem for the markets?
I think it absolutely is. I mean, it's been our contention for quite some time now that the U.S. market is very expensive, and the bar of expectations got raised higher and higher and higher as we went through 2018. Now the market's actually understanding that economic growth in the United States is going to slow substantially next year. We think it's going to be 2% GDP growth next year, and that earnings growth is also going to slow because you're not going to get the turbocharged tax cut impact that we got in 2018. I think the market's trying to justify high valuation levels, and I think the U.S. market, on a relative basis to other markets, the bar is awfully high for the U.S. I think it's much lower for non-U.S. developed and emerging, and I think they have a much better chance of having the fundamental data surprise on the upside.
Eric, if you think that the GDP growth is going to slow something around 2%, do you also believe that the Fed is being a bit too hawkish, too aggressive?
I'm not sure thinking they're too aggressive and too hawkish, but we are beginning to see wage pressure play out in the U.S. economy. I think the biggest recessionary risk that we see is the level of unemployment is very, very low, and that is going to continue to cause issues in terms of input prices and profit margins for corporations. It's also going to be a hindrance to growth just in terms of the bodies that can work. We do see recession risk rising, and we think the Fed, very like they have in the past, is going to continue in a process that is eventually going to end with a recession.